Another episode of Fun Friday with a friend, an amazing guy, someone who has been fortunate enough to get to know over the last couple of years. He, like us, is at seemingly every single event. I think you can verify that as well. We just got to see you in New York City, so that was fun, and I'll be seeing you soon here in Florida. But everyone, please welcome a very special guest, Mike Sullivant with Aspen Funds. How are you today?
I'm good, Craig. Thank you so much for having me. I always love getting to spend time with you.
Yeah, likewise. Well, I'm really excited for the show because a lot of our investors and a lot of people that are in the industry or maybe want to get into alternative space have a lot of different needs, have a lot of different questions, and there's so many angles you can go. And I think really when I think of Aspen Funds, I think of a couple of things. Professionalism, really great team and guys, which I think kind of goes hand in hand with professionalism, but options. And I would say Aspen Fund has distinctly more options than most groups. And I definitely think they're not diversifying, if you will, where they've got too many, but they're really good at what they do. So we're going to get into those. But before we do, we'd love just to hear a background about who you are and how you got into that chair today.
Love it. Well, based here in Kansas City, I've spent my entire life in real estate in some capacity. So I found myself in my first big boy job was actually while I was in college. So I went to Kansas State University, was going to business school, and uh, had my now wife was my girlfriend at the time, and I was really serious about like, hey, I got to figure out how to provide a life for us, and this is the girl I want. I found her, and I want her. So now I got to figure out how to be a big boy. So 19 years old, and saw an ad for a local property management company that said part time to become full time. I was like, that's what I need right there, and got in and just started learning the business of property management by accident, really, and had no grid for anything about real estate. Truly, just a young college kid trying to figure out his way in the world. And so the long story short is I came out of college. I worked all my way through college doing property management. It kind of elevated through that organization. So by the time I got out of college, I had a business degree. I had, 3.5 years of experience in property management. And so the quickest way for me to make the most amount of money coming out of college was stick around in the industry. And that's exactly what I did. So I went more the corporate route, moved back to Kansas City, where we're based, and got in with some large multifamily groups doing kind of luxury multifamily, 50, 60,000 door type of groups, and really learned the business there, worked up the corporate ladder. After a few years, really got to the point where I felt the need to drive more value and move the needle more. And I realized quickly, like being in that size of an organization, I learned I learned the most efficient way to do things. I learned probably the best practices of how to do that. But myself and my role at the time, I wasn't able to move the needle there. So that really led me to an impasse early in my career to start pivoting towards investing myself. So started doing some single family is usually the lowest hanging fruit. So started doing some single family flipping and started making money doing that, and while also pivoting to small business. So learned all the ropes from an ultra wealthy real estate investor here in town, and ran all of his companies and his portfolios across multifamily, industrial, retail. I'm pretty much touched every type of asset, and really learned how to become kind of an owner, and learned continued to learn more about what real estate investing really is. So that was a fantastic experience. And kind of long story short of how I got to Aspen is I have relationships with Ben Frazier's our chief investment officer, Bob Frazier, one of our founders and chief financial officer. So have known their family for quite some time. They're here in Kansas City as well. And Ben and I just had a great friendship, have known each other since we were young. And it was kind of perfect moment, serendipitous type of situation, whereas I was at a stage with a company that wasn't wanting to grow, and I was wanting to grow. And Aspen is definitely looking for a lot of growth. So it's been a great kind of transition into touching the stuff that I really want to do, which is more focused on the investments, more focused on creating passive returns for investors, super passionate about financial freedom. Along the way, real estate has provided me a lot of financial freedom and a lot of wealth creation. And as a result, I'm passionate about bringing that grade of investment to our investors. So it's kind of created a perfect marriage, if you will. So that's the short version.
Yeah, that makes sense. And I think similar to you, the enthusiasm, and it's so cool that we get to be in a position where we are probably like much like you. I also invest heavily in our deals, and it's really cool to help other people with their goals because they're looking for the same thing that we're thinking about. So everyone's so kind of tied in on that, Kool-Aid drinking, personal development journey and financial freedom journey together. It's really fun to be in the weeds of that. It's actually highly infectious. I don't know if you've had that experience before, but I
100%.
certainly feel it every day.
100%.
Yeah. So with that said, how long have you been in with Aspen Funds?
So coming into over 2 years now, and into the third year. So no end in sight.
Yeah, perfect. Kind of similar to myself, came out at the same time roughly. So with that said, I kind of want to take a different angle than I initially thought here, but you kind of opened up a lot of great things. So first off, kudos for you for kind of working your way up and getting some experience while you're, the hardest time to do so. I'm sure you getting a job out of college was right away with you kind of same with the same group, which is the hardest job to get is the first one. You need a job to get a job, as they say. So that's awesome. But would you say that you are grateful for the experience of kind of seeing the very, very corporate world of things and then getting into something that's a little bit, I'm not going to say not corporate, but maybe a little bit more, I don't want to say small because you guys aren't small by any means, but smaller from a probably number of bodies perspective?
Yeah, 100%. No, I'm very grateful. Um, I think things happen for a reason, and I think experience builds on experience and builds and continues. So if you have the right mindset, there's wisdom to be gained even in the most difficult situations. If even if it's not a place you want to work, you're still learning what not to do. So I, I have definitely found that in my career. So I think what I realized in the corporate world was, hey, this is max level efficiency. Like this was a small business once, and now this is grown to a humongous business. So I think what I really realize is where I can drive the most value and I can use the breadth of my skills is really in a smaller business that's more nimble. And it takes, I kind of look at it in terms of like if you're driving a boat and you got a small speedboat, like you can move. If you're turning a battleship, it takes a lot of energy. It takes a lot of time. It takes a lot more to turn a battleship than it is to, move your little speedboat. So I think that's what I really made a decision earlier on was I need to be in the speedboat. I like being at the ground level. I like driving the value in any way that I can, and getting my hands um, closer to all the things that our business is doing. So, but to kind of answer your first question, I wouldn't necessarily change it. I'm sure there's certain aspects I wish I could have done better, but that's a waste of time to look,
Yeah.
to try and imagine it different. So it happened the way it was supposed to happen, and I just look at all those opportunities as learning opportunities to apply to my now situation and so on.
And I'm sure sometimes actually the corporate structure is really productive in many respects because if you do work with, let's say a emerging group, obviously I don't think Lone Star nor Aspen Fall or DMUT are emerging, but if you do work with a group that's maybe under 20, 30 people, there are some actually benefits to seeing what that corporate size looks like, how corporate companies really do run, from a nature of things being appropriate, not appropriate, just standards, certain things like
Yes.
that. There's a lot of benefits. There's pros or cons. I would say the cons in working in big system is yes, like there is probably a proof of concept this business will be around for sure, but your impact will be less felt. But there's not probably as much of a way to work up versus if you're with Aspen or with a company like Lone Star or someone similar to us. If you really hit the ground running, you do well, your job security is indefinite. I would say as long as you're on your P's and Q's and you keep doing the right thing. but you also can just grow nicely with the firm and company and kind of ascend in that respect and also have a greater impact there. It's kind of interesting to your point about doing things differently or just going through the corporate structure. I had one job where I was in a corporate setting, if you will. I won't say the name. It was a technology sales company. I was doing, SaaS, whatever you want to call it, for a really productive company. It's a household name. Everyone knows them. And one thing I'll say is I learned so many amazing lessons, but I think the biggest lesson is I do not want to be here. I do not want to do this. And having kind of a very, very hard limit on income was also something that was really depressing for me day in and day out. And I just could not live that day in and day out. Like it really crushed my soul. So I got back into residential real estate and then I got back into this stuff. So just a side tangent there that there are pros and cons. But yeah, I think you learn more quickly that what you don't want to do. And that was certainly the world I did not want to live in. I was just not cool with kind of doing the typical plan, if you will, clock in, clock out, request vacation days. That just wasn't for me, frankly.
Yeah, I'm with you. You'll like this story. I would say this was the moment when I realized that I couldn't do large corporations anymore. Was working for a big multifamily company, national group. Was working kind of in a special capacity to solve uh, portfolio problems where they had vacancy issues and things like that, and really applied a lot of the things I had learned prior, and we solved a big problem in a very short amount of time that they thought, I mean, it had been decades that they hadn't solved this problem, and it just needed somebody's attention, and it got solved really quickly. And so then I kind of took it upon myself, as we had access to a full intranet within the company, to evaluate other assets. And so I went and did my own analysis across the entire portfolio, and I identified basically 15 other properties, communities that had the same basic issue, and how we could solve that. And by using the same thing that we had just proven, and added a significant NOI to the bottom line. So I pitched my way up all the way to the CEO of the company, and I had a full plan, and I said, here's, conservatively what we would achieve by fixing these vacancy issues by this program. And I said, I'd need some special permission. So I'd like to be promoted to be able to handle these projects. And they said, we're not ready for this. And you'll appreciate this, it was $5 million in NOI add that they already had that they just weren't achieving. And $5 million in NOI that we could add within a year and a half. And they said, we're not ready. It's going to be 5 years. And I was like, 5 years?
That's $25 million.
It's just insane. So that was the moment where I was like, okay, there's something else happening here that maybe I was too young or something. I just didn't understand. But that was the moment when I was like, I cannot do this anymore. So
Yeah, well, it's fun to identify things, to move quickly, and to make the change and kind of feel confident in that. But as you mentioned, $5 million. Well, $5 million times 5 years, that's $25 million. I'm no mathematician here, but that's a substantial amount of equity in dollars that you're leaving on the table there. And then also, never mind the investors.
NOI. So divide
Yeah.
that into your cap rate, right? Like the value creation is just enormous.
Yeah, that's free cash flow. Correct. Yeah, that's wild. So speaking of NOI, speaking of cash flow, let's get into the product types at Aspen. So I think some people have an idea, but maybe just give us a refresher and just an overview of all the different types of investment vehicles that you offer.
Yeah. Well, for those that don't know us, what we really pride ourselves on is looking at macroeconomics first. And what that is kind of a guiding, force to help us identify timing and establish what asset classes are best supported from an acquisition standpoint. So we're not fully vertically integrated like a Lone Star, where you guys add value through vertical integration. Where we can, de-risk is by being driven off of macro. So what that functionally looks like for us is we've got funds that range from, very conservative mortgage note funds to, private credit funds in, more of a debt position on multifamily, industrial. We've got real estate equity funds that are doing multifamily, industrial, retail type of investments. We also do oil and gas investments. So what this has really created is a lot of diversified offerings with different strategies. And so we like to think forward first and look at the data, be very data driven from an economic perspective, and then distill that down into the asset classes that we're going to go after today, and that have underlying economics that are well supported for the next 5-10 years. So that's what people know us for, and we've had great success for our investors, and no end in sight. So that'd be kind of the short version of what we're up to.
Right. And then let's talk about the products. I know just from my overview, there's industrial, there is oil and gas, and then there's debt investing, and then I think it's pref positions, and then there might have a multifamily bucket. So let's kind of just dive into that now.
Yeah, so a couple of our key offerings, like today, we'll just talk about what's available today, would be one of our flagship funds is the Aspen Income Fund. So this is very conservative mortgage note fund. These are predominantly what are called reperforming loans. Very attractive product and focused on creating a lot of cash flow and consistency. So that fund is over 11 years running now. It's never missed a preferred return, never missed a redemption for anyone that's ever needed to, exit the fund. So it's steady Eddie, kind of steady Eddie as we can get. So nothing super sexy, but we like that about it. It does exactly what it's designed to do. Kind of a step up, that would be kind of more conservative. Kind of a step up from that would be our private credit fund. So this is focused on preferred positions in commercial real estate assets. So this would be kind of mid-size, multifamily, industrial predominantly, where we're coming in either as preferred equity, mezzanine debt, or bridge loans. So that fund can kind of do a few different things, but focused on commercial broadly, but more concentrated on those two sub asset classes. There may be some retail deals in there. There might be some self-storage. So we really are kind of cherry picking where are the best deals that need this type of money. So that would be kind of a step up. And then from there, we syndicate across kind of our biggest vertical would be industrial. We've got a very big pipeline of development. What we've really find kind of macro level is that there's a huge reshoring trend that we've seen, kind of accelerated by COVID, is a lot of manufacturing being brought back to this region, and there's just not enough inventory. So we are very bullish there and doing a lot of industrial development. We're developing 1 million square feet right now, and we've got probably 8 million more on deck. So lots. That'll be a big one for us. We do syndicate multifamily. We don't do it. We do it periodically. So it's kind of specific deals that we feel that we can add value to, mostly in the Midwest. So not focused on major markets, usually kind of mid-major markets. Kansas City is where we're located. That would kind of this region and similar markets fit our profile.
Like Des Moines maybe as well.
Yeah, things like that. But again, very, very picky and choosy on those type of deals because we're not vertically integrated. We really are looking for the right deal for our investors. So we'll do deals like that. We've got oil and gas funds would kind of be the next step up from obviously real estate equity deals. So these are more diversified funds that are focused on creating buying into a lot of existing production where there's a ton of income, and then we create additional upside through developing in proven fields. So it's not purely a drilling play. It's not mineral rights. It's working interest where there's existing proven production that's operated by major companies. So these are mostly publicly traded operators who are doing the day-to-day drilling. And then we have an interest in their lease, a split of their revenue. And then we diversify that across hundreds of wells. So that's more cash flow focused, but then you get these kind of really nice tax benefits that come alongside of those to create some nice offsets. So that would be kind of the full, if you look at a risk continuum, that's kind of conservative up into opportunistic.
Right.
And the returns kind of follow. So.
Yeah. Well, I took notes here, kind of just taking note. So let's kind of just break all of these down if you don't mind. So let's go to the mortgage notes to start. So that's like a promissory note, if I'm not mistaken. And then you mentioned that it's maybe reperforming notes. So is that basically someone that maybe missed a payment at some point? Someone might be behind and then has historically good debt credit. How do you identify the buckets of notes that you're basically buying there?
Yeah. So this is, in some ways best kept secret. So this is a reperforming loan is a loan that was, this single family owner occupied home generally, and they had a mortgage with, name your bank, right? And they had a default at one time in the past, which created what we would call a modification. So the bank, part of the, in the wake of the great financial crisis, one of the legislation changes for banks, the regulation changes, was that they had to hold cash reserves against that loan. And so it creates cash drag for the bank. And it also can affect the rates they get with the Fed. So they would take that out of their portfolio and sell it at a discount. So it may be performing even, but they still have to hold cash reserves against it. So we've been, for a decade plus, been buying non-performing and reperforming loans. So they're kind of different, different risk profiles. Reperforming is that they've reestablished payment history. So we'll buy those at, 65, 70 cents on the dollar. So they owe say they owe $100,000. We're buying the paper at $60,000, $70,000. So we've built in a nice profit center, and then we're buying it to hold it for the cash flow. So we've bought thousands of these notes, and we have them in kind of our performing note fund, which is the Aspen Income Fund. So that portfolio is predominantly those reperforming loans where they had a hiccup, they had a job loss or a divorce or something like that, but they're still credit worthy. It's still more of a distressed note, but we've got a big profit center built in. So that fund is, again, very conservative. We've got a big equity cover in the fund. So 50% kind of leverage ratio is kind of where that fund lands. So lots of equity cover.
Yeah, so 50% equity ratio. And then also if you're buying the paper at a discount, right? So theoretically, if you, I guess, best case scenario, no one wants to foreclose, but best case scenario is, hey, they keep paying. They had, a bad situation in their life. It happens. Things happen in life. And, they start paying again and you're fine. Then you make some cash flow on that. But I guess if you're buying it at a deep enough discount or at, just a solid, fair market price in that kind of world and sector, in the event that they do default, you can kind of foreclose it and take the property at a good note. So it's kind of
Correct.
Darned if you do, darned if you don't, but good either way, anyway, slice it. Is that kind of what you're experiencing?
That's exactly it. Yeah. I mean, that's why we like the safety and security of this type of investment, because if things go wrong, we still make money, and our investors are, we're in a lean position on all these. Obviously, we're the bank in a sense, so we would call this fund, we're lien lords, we're not landlords.
Right. That makes sense. And then what would a investor typically expect, do you think, to have from a return perspective, if you're allowed to mention it, from a compliance perspective? What is a return metric someone can maybe anticipate in achieving in this scenario?
Yeah, we got two share classes. So we've got $50,000 minimum investment that'll be kind of more of our retail share class. Then we have more of an institutional share class, which is a $2 million minimum. And it's a fixed return. So we pay a fixed 9% preferred return for the retail share class. And we have a 9.5% preferred return. And that gets paid monthly with optional compounding. So if people don't want to take distributions, they can reinvest the earnings and just let it compound. So we find the flexibility of this fund gives a lot of people those needs. And we also have a lot of liquidity in the fund. So the lockup period is only a year. So after that 1 year, people can redeem out of the fund if they need to, reallocate them, but it's also an evergreen fund that's designed to operate far into the future. So they can kind of set it, forget it, or not. So they kind of have optionality to do what they like.
And just confirming it's a fixed rate. So there's no upside. It's just, hey, straight 9.5%. Don't want to think about it. Pure cash flow.
Pure cash flow. Exactly.
And would this be considered what would be known as interest income?
Earned interest income is how it gets broken out. Predominantly, because there's some profit center built in. There's about 15% of the income historically is capital gains. So there's a little bit of efficiency there, but predominantly is earned interest income.
Yeah, and I just want to articulate that to some people, and this is different options, different people. If let's just say you're a typical, W-2 person, some of the advantages in real estate you actually can't take full advantage of with kind of the cost segregation and whatnot. You have to be a real estate professional for you to get full effect on it. Of course, if you are selling stock and you have a capital gain that you need to offset, then the new investment from the depreciation can offset that there. But if you're just I guess I'm not gonna say normal. If you're just an investor looking for some sort of dividend interest income, this is your route to do it. There's no tax advantage to it, but it's a really nice way to kind of have a subset of your portion of your portfolio. If I were to say, hey, you've got $1 million to invest, there is 100% going to be a place in your allocation for interest income. I think it's essential for the cash flow. And you might have a really great multifamily deal from a group like Lone Star Capital, but the cash on cash
Exactly.
may not hit your threshold. Or let's say you've got a development opportunity, but you love that, but you want the income. Well, that really blends your return profile to get you some cash on cash and some equity growth. So just for those investors thinking about this, capital raisers who are listening about, how can I kind of shuffle my portfolio around to kind of hit different needs, kind of different classes and whatnot, that's certainly a good option. And then do you allow capital raisers to come into your, I guess kind of a fund of fund kind of scenario into your investment? Or is this just straight going into it as a investor?
Yeah, we do allow fund managers. I mean, this particular fund is not a high yield fund, so there's not a lot of margin in a sense. So I'd say this particular fund doesn't generally lend to fund managers, um, or doesn't function very well and for fund managers. Um, because again, we don't have a whole lot of margin either. This is it's almost we create a fixed return for the portfolio almost in some ways. So
Right.
we just don't have a whole lot of spread that we can give away more of our position to help create a spread. So our other funds that have some more yield, of course, we're always going to make way for that.
And this wouldn't be like a hard money account or hard money fund. This is just kind of a, hey, you're making money, you're having income in there. It's mortgages, not a fix and flipper, forcing some value in there. Is that correct?
We do blend a little bit of the fund with some other assets. So over 60% of the fund is those reperforming loans, and then we'll kind of work in some residential hard money, shorter term type of capital there, and then kind of low leveraged commercial bridge loans.
Makes sense. Very cool. So thank you for the breakdown there. Now let's get into the next type, which is private credit. And I almost feel like, and don't take this the wrong way, but private credit's been kind of a buzzword because I'm like, what the heck is private credit? But then he mentioned it's kind of like a preferred equity position, it's a mezzanine position, and if I'm not mistaken, my notes here say that it's a multi and industrial. So what does that look like? And can you kind of break that down high level as to how you fit in the capital stack? Are you the
Yeah.
common, or I guess not common equity, but are you not the debt? Are you maybe, I think you said bridge there. So how does that fundamentally kind of shake out?
Yeah, I mean, private credit as a sector is pretty broad. It can do a lot of different things. So when you hear
Yes.
private credit, I mean, some people are doing, private equity type of investing in there, like
That's
so
why
the,
it's a
the
little bit of a
underlying
buzzword.
assets.
It's
It's
yeah, it's a bit of
huge.
a
Yeah.
buzzword. It's
So
loosely and liberally used, I would say, to a certain extent.
I would agree. Yeah. So kind of specifically, what we're doing in this fund, as you mentioned, is multifamily and industrial is kind of the heavier allocation, and so more focused. About 50% of the allocation is focused on preferred equity positions. So if you're looking at your capital stack, you have your senior, you'll have your preferred equity, then you have your common equity and general partners. So we're behind the senior loan, but ahead of all the common equity. And so why somebody would do that is one, credit has tightened significantly with banks. I mean, private credit's not new, preferred equity is not new, none of this is new. But right now, in particular, as interest rates have risen, we've seen banks tighten credit significantly, and in some cases, it's been difficult for people to raise capital also. So as a result, they need some larger checks, and it's a way for us to diversify our holdings where we're not just purely in equity. We've kind of come more into a debt position. Preferred equity is technically not debt, so but functionally is very very similar. So like a common structure would be that you get paid. Our position gets paid a monthly, similar to a mortgage, which is just a preferred return. And then there's also an accrued interest component that's paid when the deal exits, basically. So whether that's a refinance or sale, you're kind of capturing all the interest that you've accrued, and so it kind of blends into a higher overall yield. The flexibility of being able to do that through preferred equity and mezzanine debt allow for to create win-wins. I mean, if you're, for you guys, You're like, hey, I've got a great equity play here. We're going to have a ton of returns. I can bring in some pref equity to help finish the capital stack. Their returns are capped. So in a sense, that's all of the rest is accretive to the rest of the investor. So it helps the leverage ratio for the investment, which ultimately helps the IRR for investors. So that's why somebody would do that. And there's just not other options. Banks are not going to lend in second positions. So it's an absolute needed product for this industry. So that's what we're doing in this fund and creating diversified holdings. So these are serving kind of smaller to mid-size assets. So they're $1 to $5 million check sizes. So we're growing this fund to be well over 9 figures, but we're going to deploy it $1 to $5 million at a time. So it's not super efficient for us, but it does create a lot of diversification for our investors and helps us de-risk significantly by doing that.
Yeah, well, it's exactly, makes me think of what JC Clemens said at our conference. Hey, we're guys that write $5 to $15 million checks. We'll raise, a $50 to $100 million fund here. And we know 2 deals are going to be home runs, 2 deals, maybe not do so well. And the most would kind of be in that 15% range roughly. So the
Yep.
best of the best don't hit home runs every single time. So I think from a comfort perspective, distributing evenly or maybe in that smaller window, although it's a brain and headache for you guys as the investor, as the fund manager who could potentially raise for these opportunities, that is probably music to your ears because you don't have to individually underwrite these deals, but they
That's
do,
right.
which is awesome.
That's exactly right. We got Terrence tearing away at underwriting every single deal. So
Yes. So what could an investment return profile look for that? You said there's a distribution, a cash flow because it's pref and whatnot. And there you've
Mhm.
got that. And then you also maybe have a lift. Is it a closed-end fund where you have that there? Is it a lockup? How does that kind of shake out, from an expectation perspective? Just because when you
Mhm.
invest with Lone Star, this is where things get a little bit murky perhaps. You invest in Lone Star, hey, this is a 3 to 5 year illiquid investment, so treat it as such. Hopefully no longer, but when market cycles change on you, it can be longer, and we have some that are just going to be held for maybe 7 years, 8 years, and we don't love it, and I'm sure some investors don't, but that's the nature of this game.
Yeah, it's different. So this is a 2 year lockup in the fund. After which there's no guarantee of liquidity, but we'll have enough circulation that we expect that we'll be able to provide that. So we've made that a provision in the fund. Um, from a return standpoint, we've got 3 different share classes. So we have kind of a retail share class. How it's structured for investors is $100,000 minimum. What they can expect in a kind of consistency standpoint is they're going to get a 6% preferred return, so it's paid every single month. And then you also have a profit split component at the end of each quarter. So say we just started Q4, so like October you'll get a preferred return. November you get your preferred return. December you'll get your preferred return plus 70% of the profit that was achieved during the quarter. So kind of functionally what that looks like for investors, because there's a current pay of interest we're receiving from the properties, plus some other fees and things like that gets spread out amongst the fund. We're also accruing interest, so we're booking an accounts receivable, which is a return. It just hasn't been received in the form of cash. So investors would see an increase in their net asset value of their shares, in addition to the cash flow they're going to receive along the way. So from a total return perspective, unlevered, $100,000 investment is in the kind of 12% range. And
Six
then
and six roughly then. So just for everyone knows, like if it's 12%, just 6%, on that 100K, about 6 grand annually in cash flow, and then maybe another 6 grand accruing on that, hold period. Am I understanding that correctly?
yes and no, but yeah, I
Tentatively.
mean, yeah, yes and no. There's some more nuance to that. So what will actually a lot of people are reinvesting their earnings in this fund because it is an open-ended fund. So they're wanting to compound. So the compounded return is higher because we're going to consistently redeploy cash. So the actual cash yield for somebody who's taking distributions is more like in the 9 to 11% range, something like that. So from their 12% total return, 9 to 11% of that may actually get distributed to them, but they're also still booking that accounts receivable that will get paid off in 2, 3, 5 years, whatever the term would be on the asset. So So yeah, it's just that kind of nice middle of the road type of return. It's not 9% fixed. It's a little more conservative. You're getting into double digits. If you're compounding, you're getting into kind of these mid-teen type of returns. So they're attractive returns without taking the full equity risk. So that's why this is a nice piece of a portfolio where I get consistency with some upside.
Right, and it's very diversified. It's not all in one. Some people really do the love the fun aspects, some people don't. But this is just all about options. I think, as I said, to kind of hit there, you guys do the options so well. Now let's get
Yeah.
into development and industrial development. For those who came to our conference, Mike and Steve Woodruff, similarly, they both were there at the event. Steve was just on the episode or the show not too long ago, but both these gentlemen had a phenomenal presentation of an industrial development play, which I'm sure you're raising for right now. But let's talk about the industrial development, what's going on, where you see the opportunities, where you're doing it, and just kind of the fundamentals there.
Yeah. So I kind of mentioned it earlier, but really this has been driven off of macroeconomic thesis first and foremost. So what we've seen, there's some really big demographic shifts that have been happening overseas in particular, which is a lot centered around birth rate. We've seen a big decline in birth rates, particularly in manufacturing countries, China, most of Asia. So that declining birth rate, what we're seeing is a constriction of the labor pool, which is creating rises in wages. Rises, they don't have energy independence necessarily, so you have more volatility and energy costs, which is very inflationary. So what we've seen is manufacturing, with the kind of implementation of a lot of robotics, we've seen a lot of manufacturing being brought back to the U.S. in this region because we have, one, more security. We've got energy independence. We've got more security, much more business-friendly environments, and then you're not taking on supply chain risk of a fully global supply chain. And so there's a lot packed into there, but that's kind of what's driving a reshoring trend. And as a result, we've just seen a humongous demand for manufacturers to have new industrial space, but there's not been much built. So as a result of that imbalance, right, in key markets, of course, but as a result of that imbalance, and with interest rates rising, there's been fewer and fewer starts in the last several years. So there's a lot of new deliveries that have been happening. This has been booming for some time now. There's been a lot of deliveries back, 3 years and beyond. But as interest rates have risen in the recent years, we've just seen starts just plummet, and demand has stayed pretty steady. So all of that new inventory has been absorbed, and now we're in a place where it's just opportune time. So people that can get in at the right basis on the land can work through all the entitlements effectively and get a fully teed up, ready to go deal. It's great. So what we're finding out here in the Midwest is where we're located. So we naturally are doing some deals around us. Is lending to a pretty big pipeline of Class A brand new construction that are targeting credit tenants. So these are mostly publicly traded companies who have a tenant rating, a credit rating. So it's very attractive on the back end because you got a publicly traded tenant on a 10-year lease who's got a AAA credit rating or something along those lines. And so from a sale perspective, this is a really wonderful passive asset for a lot of buyers, and it's kind of an institutional grade product. So we're creating all that value by coming in and building it, leasing it, selling it, and that's really the simple strategy.
That makes sense. So with that said, do you kind of go full soup to nuts, if you will, start to finish? Like, you've acquired the land, then you do the construction, and then you do the lease up, and then you sell it. How does that process work? Do you basically get it? Do you buy it from other people? Can you give me the whole kind of breakdown there, if you will?
Yeah. So yeah, definitely soup to nuts, and we'll kind of create a best in class, collaboration team, if you will. So Aspen, we're the developer. We bring in, particularly in our region, is kind of the top broker in this region who's a part of the development team. So interests are aligned, but also acts as our broker to do all of our leasing and sale effort. Also helps with the acquisition effort. So we do that, and then we partner with a regional builder who is kind of specializes in this space, and they can provide us a guaranteed max contract. So it really comes down to, what is your price per square foot on acquisition and construction. If you can effectively control those things, we pretty much understand, within a variance where cap rates will generally be on this type of asset. And so we kind of do everything soup to nuts, to your point. So what that looks like is we'll go put land under contract that's already, in an era where we're seeing permitted uses for that same asset type. We will come in, put it under contract, get it at the right basis, and then really where a lot of the value is created in the kind of the land phase is entitlements. So while that property is under contract, before any money is hard, before we've done really anything to the property, we've fully entitled that land. So by the time it's time to actually go hard on the money and put it officially, in a closed period, we've already have tax abatements from the city. We have guarantee max contract from the builder. We have all the permitting done with the city, all of the plans, everything is done and ready. And so when we launch it to our investor base, we can accelerate the returns because we've condensed the timeline down from, now 4-year, 5-year timeline. We've condensed that down now to 2 to 4 years. So that IRR acceleration is realized through all of the work we've done on the front end. So it's really, it's time, our time, but it is, from an investor's perspective, very attractive because we can create the appropriate risk-adjusted returns for a development play. So that's in a nutshell what we're doing.
Amazing. And that's so different from the other kind of product types where this is just probably no cash flow naturally, but just a big lift there, if you will. Is that correct?
That's right. And then, tax efficiency along the way. So you have operating losses, while you're constructing it.
Nice
K1s,
nice K1s to offset
nice
that,
K1s.
Maybe the offset, maybe if you're a real estate professional, some of your active income or your real estate professional income, or potentially, of course, with your, capital gains. So really fun to see that. Yes. So that's a really cool vehicle to achieve those goals if that's something that you're seeking. If you need to maybe offset some income, that's a very good option. But once more, I am not a tax professional. I'm not giving advice. These are just strategies that, people like myself and Mike implement in their day to day. With that said, now finally, let's talk about the oil and gas just briefly. And, maybe with the advantages there. I know there's some kind of cool stuff because that can be offset by anyone's income if you're W-2, not really necessarily a real estate professional. So be curious to hear the nuances here as well.
Yeah, definitely some nuances. And I would, caveat all of this information with this is a risky asset class. This is a commodity. So for people who don't understand kind of the nature of the industry, is just take your time, don't rush in. It can be, the tax benefits that are available are kind of the shiny coin in some ways, and you can go after something that's shiny, but it may not ever produce a return. You got a tax loss and that was it. So just be careful. But kind of specifically what we are focused on, I kind of alluded to it earlier, but we're really not interested in doing pure drilling at this stage because there are big tax benefits, but there's also more risk. So you have a higher likelihood of total loss. So what we are more focused on is coming into what's called PDP. So we purchase existing interest in leases that are in proven, developed, and producing wells. So these are, again, operated by major companies. We're buying into those at pretty significant cap rates. So these already exist, and we're buying at a discount to create a significant amount of cash flow. So that cash flow is kind of right out of the gate. You're not having to speculate very much. As long as you can kind of understand and underwrite appropriately, you're factoring that into your purchase price, and that creates your cash yield. So lots and lots of cash flow there. And then in those same fields, part of how operators keep their share price high if they're publicly traded is to continue to develop, because this is a natural resource that depletes over time. So not only does production over time go down, but it's consumed. So it's not renewable. And so they have to replenish that somehow, and that's through development. And so what we would do additionally in those same fields that are proven and developed, you have locations that are called PUD, so proven undeveloped. So those are new wells that have been proposed. All of the geology has been mapped out. It's a very attractive asset because you have a higher success rate because you've got a proven field that supports the geology and how much production, within a variance you can expect. So higher, less risky compared to, full exploration drilling, full, wildcatting, something like that. So that's kind of our strategy and our focus is create a lot of cash flow through existing production, do development, which compounds the cash flow because once that starts producing, particularly with the types of wells that we're doing are horizontal wells, so you get a big surge in production in the early years. And so that creates a ton of cash flow to kind of compound your cash flow even higher. But it also creates a lot of equity in those new wells because these are newer, younger wells. They have more life to them. And so our strategy is to, in the middle market, kind of roll up a portfolio where we'll buy, $20 million asset over here and a 30 over here and a 10 over here. And we'll roll that up into a portfolio of proven production, get a ton of cash flow, and then look to exit and sell that because you create an efficiency in the middle market for larger capital, and then we can sell that up. So that's basically our strategy, and so far so good. I mean, it can be less predictable than other assets because there's a lot of volatility in commodity prices. We don't have control over those things, so there's less things we can do to control the outcomes. So that's why the returns need to be much, much higher to offset the risk. But what we found is this, these are 25, 30% plus IRRs over 10-year life. So we're talking pretty significant returns, but that's necessary to offset the risks. And so like our most recent fund, currently we launched it in August last year. As of Q4 2023, has already been distributing 15% cash on cash to our investors like clockwork. So, and that's just the beginning. So that kind of gives you a sense of the starting point.
Amazing. Well, thank you so much for the in-depth breakdown. That was a marathon by your end, but it was very entertaining and interesting on my end to kind of take notes, listen, to absorb everything, to have a more fuller picture of what you do. So thank you so much. And I'm sure everyone who's listening will be very appreciative and should have inquiries of their own and questions of their own to ask you. That said, kind of closing up conversation here, what is getting you most excited and maybe perhaps most nervous about the changing times? We just had a rate cut. We've got the election coming up. At this point, I don't know if this will record before or after, but it's right around the corner, less than 30 days away. Crazy time. So what's getting you excited and what's getting you nervous?
Yeah, I think part of the macro is looking far ahead. So we've been doing that. So we're really excited about kind of the verticals we've created with private credit, industrial, and oil and gas. So I think we'll continue to go big on those in a meaningful way through the remainder of this year and into 2025. We feel there's going to be a lot of opportunity in multifamily. I think, distress is getting fleshed out in the market, and there's been, good deals happening this year with interest rates where they've been. That's kind of created some challenges for sure for operators, but I think a reset in basis is happening, and there's going to be a lot of great buying opportunities next year. So I'm sure we'll end up doing some cherry picked deals next year that we really, really like, and in multifamily. So lots of equity opportunity there. Buy low, sell high. So
Yeah.
I think we're excited there. Things we're nervous about, particularly, oil and gas. It's kind of two sides of a coin, right? It's like politically, there's some diametrically opposed views on oil and gas. So we happen to position ourselves, to be able to capitalize in either way on our existing portfolios. But what makes us nervous is how long we can continue to buy at the basis that we've been. So that's something we're certainly nervous about. Talks of recession, obviously that affects lots of the things that we do. So, we're certainly mindful of that. But everything's an opportunity. So I think, for us is looking for those opportunities to be greedy when people are fearful and do the Warren Buffett. And that's kind of where our model's kind of been built on is pivoting to what's something that might not be in favor. We can actually still get it at the right basis and create a more sustainable investment for a longer period of time. So I wouldn't say we're afraid or nervous too much about, too much of anything. We're just positioning ourselves and cautiously watching and waiting for the right opportunities.
Amazing. Mike, you've been such a treat to have on the show. Thank you so much for the interrogation I just ran you through. How can people get a hold of you and the Aspen Funds if they want to learn more about your investment vehicles and maybe partner with you guys and everything else in between?
Yeah, as always, our website, so aspenfunds.us, like United States. You can find a wealth of information in there on what we're doing. You can contact me. Feel free to reach out to Craig, and I'm sure Craig can connect us directly. Um, as far as some other resources, we have a podcast hosted by Bob Frazier and Ben Frazier. It's called Invest Like a Billionaire. So that's kind of taking billionaire strategies to alternative investing. So it's kind of talking pretty big picture, and then we bring in some experts to help look at lots of different things. So I think that would be a good resource to get to know us also. So yeah, I'd say those would be good ways to get in touch.
Awesome. Mike, thank you so much for coming on the show. For all those that are here still listening, we appreciate you, and we will see you next week.
Sounds good. Thanks, Greg.